Hello students, now we will discuss chapter depreciation. First of all, what do you mean by depreciation? Depreciation means fall in the value of fixed assets, decrease in the value of fixed assets due to any reason, due to excessive use, due to wear and tear, due to obsolescence, due to accidents, due to any reason. If there is decrease in the value of fixed assets, this is known as depreciation. It is an expense for the business. So we have to fix an amount while recording depreciation in our books of accounts. So how to calculate depreciation? It is not easy to calculate depreciation. It is not easy to fix depreciation, the amount of depreciation. So there are 10 methods in depreciation for the calculation. But in our syllabus, only 2 methods are there. Total there are 10 methods for the calculation of amount of depreciation. But on this level, in 11th, we have to discuss only 2 methods. Number 1, straight line method. Straight line method. Other name of this method is original cost method. Original cost method. Next name of this method is fixed installment method. Fixed installment method. This is a very popular name of this method. And the last, simple method, also known as simple method. It is very easy to calculate. That's why also known as simple method. Second method is written down value method. Written down value method. Other name is diminishing balance method. Diminishing balance method, DBM. Reducing balance method. So we have to learn these 2 methods for the calculation of amount of depreciation. First of all, I am going to tell you straight line method, or also known as original cost method. In this method, depreciation is charged on assets on its original cost, and the original cost is same for every year. That's why the amount of depreciation will remain same every year. That's why it is also called fixed installment method. So how to calculate depreciation in this method? The formula of depreciation is cost of the assets plus expenses on purchase minus scrap value divided by estimated life of assets. This is the formula for the calculation of amount of depreciation. Cost of the assets, suppose we have purchased a machinery for rupees 2 lakh, right? Expenses on installation of machinery, suppose wages or carries is given at the time of purchase of asset. That expenses will also include in the total cost of assets. Estimated life, how many years the assets will work. This is decided by the experts only. And after the estimated life of the assets, scrap value, or also known as fetch value, residue value. So the formula is cost of assets minus scrap value. Suppose we have purchased assets for 1 lakh, 20,000 we have paid for installation and after 10 years it will be sold in 5,000 rupees. This 10 is 10 years estimated life of assets. So 1 lakh plus 20, 120 minus 5, 1 lakh 15,000. This expense is for 10 years. So 11,500 per year depreciation will be charged. So this is the method for the calculation of depreciation. Every year this depreciation will be recorded in the accounts book. Second method for the calculation of depreciation, if rate of depreciation is given, rate of depreciation is given. Suppose depreciation rate is given, then cost of the assets, the formula will be cost of the assets into my rate of depreciation divided by 100. Suppose 120 is the cost, total cost, cost plus expenses, and the rate of depreciation is given 10. So 10%, 12,000 depreciation will be recorded in the books of accounts every year. So this is the way how to calculate the amount of depreciation. In written down value method, depreciation is charged at written down value, at diminishing value, at reducing balance of the assets. That's why depreciation will not remain same. Depreciation will also be reduced. Suppose in written down value method, suppose we have purchased machinery for 1,20,000. First year, depreciation is 10%. So first year, the depreciation will be 12,000. The written down value of assets will be 1,08,000. Reducing balance is 1,08,000. Next year, in second year, the amount of depreciation will be calculated on written down value of assets. That means 10,800. So this is the difference between original cost method and written down value method. In original cost method, depreciation will be calculated every year on original cost of assets. That is same for every year, 1,20,000. So the depreciation will remain same every year. Year to year it will be recorded 12,000. It will not be changed. But in written down value method, 10% of 120, first year 12,000 will be charged, but in next year, because the value of the machinery is reduced, so reducing balance is 1,08,000. In second year, 10% of 1,08,000 will be charged. So depreciation will also reduced 10,800. So this is the difference between original cost and written down value method. Now, how to record depreciation? There are two methods for the recording of depreciation. Number one, by recording in the credit side of assets account, and second one is by recording in a separate account named provision for depreciation. So let us understand how to prepare machinery account in this chapter. Let us understand how to prepare machinery account. Suppose on 1st April 2016, company has purchased a machinery costing rupees 3 lakh. In the same year, on October, company has purchased a new machinery. On 1st July 2018, in the third year, company has sold its first machinery for rupees 120. Depreciation is charged 10% on original cost method. So how to calculate, how to record depreciation in machinery account? Let us understand. So start it from the debit side. First of all, at the time of purchase of machinery, You know machinery is an assets, and the rule of the assets is when the assets increases, it will be recorded on the debit side, and when the assets is decreasing, this will be recorded on the credit side. So when we purchase assets, asset is increasing. That's why we will record on the debit side. The journal entry will be machinery account debit to bank account. So in machinery account, to bank account will be posted 3 lakh. In the same year, October 1st, a new machinery is purchased. Now this machinery will be named as machinery 1 and this will be machinery 2. The amount of this machinery is 2 lakh. Now we have two machineries. So charge depreciation at the end of the year on both of the machineries by depreciation account. On machine number 1, machine number 2. Machine number 1, the original cost is 3 lakh. So the depreciation will be on machinery 1, 3 lakh into 10 by 100, 30,000. On machinery 2, the cost of the machine is 2 lakh. So the depreciation will be 20,000 for the full year. So 30,000 depreciation will be charged on machinery first, and for the full year the depreciation is 20,000, but because we have purchased in the middle of the year, on 1st October we have purchased machinery, so depreciation will be charged from 1st October to 31st March, that is for 6 months. So depreciation will be charged on machine number 2 for 6 months only. So 20,000 for the full year. For 6 months it will be 6 by 12 of 20,000, that is 10,000. Total depreciation is 40,000. So after charging depreciation, we have to balance the machinery account by balance CD. Machinery 1, machinery 2. 3 lakh minus 30,000. The value of machinery is now 270. 2 lakh minus 10,000. The balance of machinery is 190. The total of both machinery is 4,60,000. Now the closing balance of this year will be treated as opening balance of next year. 2017 April 1st, two balance brought down. Machinery 1, machinery 2. 270, 190. Total 460. 2018 at the end of the year. No transaction in this year, no purchase, no sale. In next year we have sold. So record depreciation at the end of the year by depreciation. Machine number 1, machine number 2. Because we are using original cost method, the depreciation will remain same. For the full year, on first machinery, 30,000 will be recorded. And on second machinery, now it will be recorded 20,000. From 1st April to 31st March for the full year. In previous year, 10,000 was recorded just because we have purchased machinery in the middle of the year. 6 months were there. Now full year depreciation will be recorded here. So total depreciation 50,000 by balance CD. M1, M2. 270 minus 30, 240. 190 minus 20, 170. Total of debit side is 460 and total of credit side is 460. Now the closing balance of this will be the opening balance of next year, 2018 April 1st. To balance brought down. This balance will be transferred here. Machinery 1, machinery 2. 240, 170, total 4,10,000. Now this year we have sold our first machinery on 1st July. So right here, July 1st. By depreciation first of all. On machinery number 1 for 3 months only. Because we have sold machinery on July 1st. April, May, June, we have used this machinery for 3 years. That's why 3 months depreciation will be charged from 1st April to 1st July. April, May, June. 3 months we have used this machinery. So 3 months depreciation will be recorded here. 30,000 for the full year depreciation. For 3 months we have to calculate into 3 by 12. 7,500. Now by bank for the sale of machinery. The entry will be bank account debit to machinery. So by bank machinery sold for 1,20,000. By statement of profit and loss. If there is a loss, record in the credit side. If there is a profit, record on the debit side. So how to calculate? 240 minus 7,500. It is 2,32,500 minus 120. So 1,12,500 is the loss. And now at the end of this year, 2019 March 31st, we have just one machinery for the depreciation. By depreciation on machinery 2, for the full year depreciation will be recorded 20,000. By balance CD 170 minus 20,000, 1,50,000. So this is the way how to prepare machinery accounts. This closing balance will be the opening balance for the next year. So right here, to balance brought down, 1,50,000. This is the way how to prepare machinery accounts.